You know, most advice on building wealth is pretty basic, right? Save more, pick the right stock. But let's be honest, that's just the ground floor. Today, we're going to take the elevator up to the penthouse and deconstruct the actual architecture the financially sophisticated use, not just to make money, but to protect it and pass it down for generations.
So, we're going to break this down into 5 core pillars. Think of these as the blueprints for a system that's built for the long haul. And it all starts with the cornerstone, understanding that there are really 2 different rule books everyone's playing by. All right, the first and honestly the most important thing to wrap your head around is this. There isn't just one tax system, there are 2. There's one for people who earn a living and a completely different one for people who own the things that provide that living. And that one distinction, it changes absolutely everything.
Look, for an employee, the formula is simple. You earn money, taxes get taken out first, and you live on what's left. It's a system of compliance. But for a business owner or an investor, it's a whole different game. Income comes in, you get to subtract all your legitimate expenses, and you're only taxed on what's left over, the net. And here's the secret. The tax code is really just a big book of incentives. It's designed to encourage people to do things the government wants, like create jobs or provide housing. Getting this is the key to unlocking everything else we're about to talk about.
So how do you actually position yourself to use all those incentives? Well, that brings us to pillar number 1, your business's legal shield. And let me be clear, this isn't some optional add-on. This is the non-negotiable foundation that separates your business life from your personal life, and it's the platform for everything else. The LLC is basically your personal fortress. If your business gets sued or racks up debt, this legal wall is what protects your personal stuff. We're talking your house, your savings, your car, from being taken. Without it, in the eyes of the law, there's no difference between you and your business. You're completely exposed. But, and this is a big but, a fortress only works if you keep the gate shut. You have to treat it like a real separate entity. That means getting an employer identification number, opening a totally separate business bank account, and never ever mixing your personal and business money. If you start paying your mortgage out of the business account, you could pierce the corporate veil and that protective wall just crumbles. Okay, now here's where this structure gets really powerful. With a standard LLC, every single dollar of profit gets hit with a 15.3% self-employment tax. Ouch. But by filing one simple form to have your LLC taxed as an S-Corp, you get to split your income. You pay yourself a reasonable salary, and yeah, that gets taxed. But all the profit above that salary, you can take that as a distribution, and it is not subject to that 15.3% tax. For a business that's making decent money, this one move is a total game changer. All right, so our legal fortress is built. Now it's time to move on to the next piece of the system. Using assets to your advantage. And when we talk about tax incentives, trust me, very few assets can compete with the power of real estate. This is a huge mindset shift. Most of us think that to get a tax deduction, you have to actually spend money. But in real estate, some of the biggest and best deductions are what you'd call paper losses. They don't cost you any cash out of pocket, but they create very real tax savings. And the magic behind this is a little thing called depreciation. Essentially, the government lets you deduct a piece of your property's value every year, based on the idea that it's wearing out. Now here's the crazy part. It doesn't matter if your property is actually skyrocketing in value in the real world, you still get to take the deduction on paper. It's a phantom expense that saves you real money. So what's the bottom line? Well, let's say your properties generate a paper loss of, say, $50,000 from depreciation. Boom. You can use that to wipe out $50,000 of your regular job or business income. That's a tangible benefit. It means more cash in your pocket because you're paying less in taxes on your primary income. And listen, that's just scratching the surface. The experts take this to a whole other level. They use things like cost segregation studies to speed up depreciation, or they qualify for what's called real estate professional status to unlock even bigger deductions. And we'll get to that last one, 1031 exchanges, in just a minute. Okay, so you're building up all these assets inside your legal fortress, and they're growing in value. Awesome. But there's a catch, right? How do you actually use that wealth? If you sell, you get slammed with a massive tax bill. This next pillar is all about accessing the value of your assets without ever having to sell.
This leads us to a strategy that's famously known as buy, borrow, die. Sounds a little grim, I know, but stick with me. First, you buy assets that go up in value, real estate, stocks, you name it. Second, instead of selling them to get cash, you borrow against them. A loan is an income, so the cash you get is completely tax-free. You can live on it, reinvest it, do whatever, all while your original asset keeps growing. And the die part? Well, that's the grand finale we're getting to.
For real estate investors, there's another incredible tool for this, the 1031 exchange. What this provision lets you do is sell an investment property, and as long as you roll all the money from the sale into a new, similar property, you pay zero capital gains tax. That's right, zero. This has led to the famous saying, swap until you drop. You can literally just keep exchanging one property for another, bigger one, your entire life, growing your portfolio and pushing that tax bill further and further down the road. You're effectively deferring the taxes forever. And that leads us to the final and I'd say most profound piece of this entire architecture. How does all this wealth and all these deferred taxes actually get passed on to the next generation? This is the end game. This is where it all comes together. Seriously, just think about that for a second. You have a lifetime of gains from investments where all the taxes have been kicked down the road through borrowing or 1031 exchanges. How do you make sure that massive tax bill doesn't finally come due at the very end? The answer is hiding in plain sight in one of the single most powerful provisions in the tax code. It's called the step-up in basis. When you pass away and your heirs inherit an asset, the price you originally paid for it, your cost basis, becomes totally irrelevant. It gets erased. The new cost basis gets stepped up to whatever the asset was worth on the day you died. In one move, a lifetime of accumulated capital gains is legally and completely wiped off the books. Let's make this crystal clear. Say you bought a house for $100,000 and now it's worth $500,000. If you gift it to your kids while you're alive, they inherit your old $100,000 basis. If they turn around and sell it, they have a $400,000 taxable gain. That could be an $80,000 tax bill. But if they inherit that exact same house after you pass away, the basis steps up to $500,000. If they sell it the next day, their taxable gain is zero. Their tax bill is zero. The timing of the transfer is everything. So how is this actually done? It's not some complicated secret maneuver. It's just basic estate planning. Using a simple will or a revocable living trust ensures that your assets are transferred at death. That's the trigger that unleashes the power of the step-up in basis. So when you step back and look at the whole thing, you see it, don't you? These aren't just a bunch of random tricks. They're all interconnected parts of a deliberately built system. From the LLC shield to depreciation to borrowing, all the way to the final step up in basis, it's a multi-generational strategy. It really leaves you with one big question. If this is the rule book, why aren't more people taught how to read it?